Well, first of all, welcome. Thank you for joining today's web conference. This is the City National Rochdale Economic and Investment Update. My name is Chad Stayskull, and I'm the Managing Partner of Eagle Wealth Management. Eagle Wealth Management was founded 12 years ago with a pretty simple reason. We knew that clients needed someone on their side, someone that's going to put them first. And we're here to help. And part of that is to help you sort through the uncertainty, especially in times like this, and help you focus on what really matters, which is to reach your goals. I know there's a constant flow of information coming at you right now from various media sources. There's news 24 hours a day, and the main goal is to increase viewership, often by fear and extreme views. That's really helpful when you're planning for your future. And I'm pretty sure that's why you joined us now, for us to hopefully cut through the clutter and give you some solid information. Today, I'm very excited to have the CEO of City National Rochdale, Garrett D'Alessandro, and City National Rochdale Portfolio Manager, Robert Mextroth, with us. For those of you unfamiliar with City National Rochdale, they are one of the companies we partner with for unbiased and comprehensive research. Their firm manages over $45 billion in assets, so I think it's fair to say they have a little bit of experience. We're looking forward to hearing from Garrett and Robert on their insights and analysis of the progression of the coronavirus outbreak, the impact of the economy, and also financial markets. Garrett and his team have extensive experience through numerous bull and bear markets. The entire research group and investment committee believe this economic and investment environment is the most unique experience they've had in their careers. Before I turn the call over to our team, please note that all participant lines will be muted during this presentation you're about to hear. But you are welcome and encouraged to submit written questions during the presentation. To do so, use the Q&A box at the bottom of your screen. We're going to collect the questions and try to answer as many as possible by the end of the presentation. And if we can't get to them, we'll hopefully be able to get an email out to you with an answer. And with that, I'm going to turn the call over to Garrett D'Alessandro, CEO of City National Rochdale.
Thank you, Chad. Hello, everyone. Good afternoon. My name is Garrett D'Alessandro, and I'm pleased to have the opportunity to share our views on the outlook for the economy and the coronavirus update. I'm going to cover a couple topics, and then I'm going to hand it over to my teammate, Robert, who will cover the economic portfolio position sections. Let's start with the major developments this week. Many states are starting to implement their reopening plans. Washington, Oregon, California, many of you probably have followed some of those reopening plans. What we do, we have a research team and we look at all of the major states and we see how reasonable and what the timely reopening process is. And by and large, we think the states are developing appropriate plans that are achievable under the circumstances that are impacting each state. New York obviously is in a much different situation than California, and California is different than Washington or Oregon. The Federal Reserve, so when I think of the government, I think of the Federal Reserve, and that's the bank that prints the money, and then you have the federal government that spends the money. Both bodies of government, the printing and the spending, are operating in full force. And over the first several months, or the first couple months of this crisis, they printed a lot of money and they put a lot of money out into the hands of the unemployed, small businesses, and we think there's more to come in support of small businesses. State governments need money and local governments need money. There's a lot of views on whether that printing and that spending is good or bad. We have a view on that to follow. When we started this corona crisis, the Oxford paper printed a projected mortality rate of 5%. And when we did the math, everyone said that could be 1 million or 2 million fatalities. Then we went into the shelter in place, work from home, and all of the social distancing protocols across the different states. And the reality now is it looks like the mortality rate will be somewhere around 0.0001 or 0.0002. So clearly shelter in place has served a good purpose and saved a lot of lives. How much longer and how the reopening goes will determine that, but we think the goal has been achieved. When we think about the impact to the unemployed and companies, each year, all of the S&P 500 companies 4 times a year they meet with Wall Street analysts, and we have our team of equity analysts that listens to the conference calls, speaks to the management, and we're doing the first quarter calls with all of these companies. And while we had an estimate of how bad it was going to be, it's turned out to be not quite that bad. It's not good because they're down or they're not meeting their goals, but it's not as bad as we thought it could have been. But what is a little worse than what we thought is no company has any real certainty or clarity on what the next couple months are like. So they're not giving us the concrete sense or even a reasonable range of what to expect for earnings going forward. I sit on the investment committee. That investment committee, as Chad mentioned, has 6 people in total. Many of us have been through 4 bear markets. This is my 5th. Most of the members of the investment committee are in their 4th or 5th. And that tells you 2 things. 1, we're old. And number 2, we understand a lot of the characteristics of what happens to the equities or the bonds during these bear markets. And as important as the technical mathematics of the economics and the earnings and the economy and GDP is the behavioral component, which is what goes through the mind of the investor, how much anxiety is created. So we have a sense of the impact on bear markets on investors, and we understand it does create a set of behavioral concerns. So we want to say a couple things. 1, the equity market has recovered from the worst of the decline. Now we think it's probably a little bit ahead of itself or a little bit ahead of the fundamentals. By that, we mean the market now has to pause or rest or maybe pull back and retest a little bit of the decline to get coordinated better with the fundamentals. So far, out of the 500 companies, roughly 200 have reported, and we've said that they're really not able to give us a good sense of confidence on their earnings and revenue going forward. Despite those 2 points, our analysts are always digging into which companies, what valuations might be attractive, and they do see a couple potential opportunities that they're going to be willing to invest in at this time. The federal government, both the Federal Reserve and the U.S. government, is looking at how each state is going to open or reopen, and depending upon that, they'll determine if stimulus is appropriate or necessary at the state level. Last year, as you've probably heard from Robert, we've had a late cycle playbook. We've had a 10-year bull market, 10-year economic expansion. We knew we were late in the cycle, so we adopted this late stage investment strategy, and that actually turned out to be very helpful because of the things that we did to preserve some of the capital. We went into this crisis, so we're now in the out of the crisis investment strategy, and we're looking at stocks, at bonds, high yield bonds, global stocks. Where are the companies that have agility, resiliency, a dynamic business model? Where are they? And we want to put our money in those type of companies. We get a lot of questions on what does this all mean? We're taking on a lot of debt. We're spending a lot of money. What is the legacy of the coronavirus on the U.S. standard of living in the future? We're going to talk about that in a little bit. The final point that the investment committee is really focused on is this is a one-time big shock to the system. And when we look at that, they want to put this in a category. They want to put this in a very unique situation and manage this $3, $4, $5 trillion deficit. They want to get it organized in a way, we want the government to get it organized in a way so that it does not have a future impact on inflation. And there are means and methods economically to make sure that that doesn't happen. We have 3 indicators relating to the coronavirus. The first one is green. So when the indicator is green, what that means is looking ahead 2, 3, 4 months, we feel it's okay, it's good, it's proceeding in the right direction. So we think the spread, the level of spread, the magnitude of the new hospitalizations and the mortality rates, while we're not done with the coronavirus, when we look ahead 2, 3, 4 months, and we're going to show this in a later slide, we think we're going to move from the extreme danger zone that we were in as a country over the last 6 to 8 weeks and we're going to move into this yellow zone, so we think we're good to go there. Testing, this is a very controversial topic, and in Washington, they have a much higher threshold for testing than in Oregon. New York has a totally different threshold than the other states, so each of the states has their own thresholds on what level of testing they need to get to, and they have that right? That's the purpose of each state, to make their own rules. Generally speaking, we think most of the states are getting organized or are reasonably organized, and they're mobilizing labs, and they're mobilizing the drugstores and the CVSs and the testing centers and the test equipment. And we do think in the couple weeks ahead that they'll meet the sufficient, the minimum acceptable, not the ideal, that's still a couple months away. We think the conditions will be sufficient to do the reopening. And I've already talked about the policy response from the government. When we think about the coronavirus, quite frankly, being from New York, this is almost only a New York dominant situation, and dominant in a bad way. You can see here, California, Washington, and Oregon, not that there are no cases. Clearly, any case is not good news, but New York has been the epicenter of this hospitalization ramp up, and you can see the downturn in that. Washington and Oregon have a minimum number of cases, and we're all thankful for that. Okay, so when we look at the hospitalizations at the peak, right, you can see again, California, 6,000, Washington, Oregon, you all listeners probably know that. And then look at the magnitude of the size of the outbreaks in New York compared to the other states. And that's why one of the states that we're focused on is New York. We're heavily focused on what their protocols are, what their test kit, what the equipment is, what the turnaround time, what their reopening plans are. And we're looking also at California and Washington. Similar analysis here. This is fatalities, and you can see disproportionately negatively impacting New York. Now, there's a lot of questions about the second wave. And when I think about the second wave, we've done the analysis on China and South Korea. And all you want to focus on in this chart is, you see the black line had a swing up and then a ramp down. And once that black line ramped down, it basically stayed at no cases. That's China. As everyone knows, China has over 1 billion people. They have had no second wave, no second wave. Now, they have a different culture, they have a different discipline, they have a different protocol, but they clearly were successful with their testing, tracing, isolation, their technology deployment, of making sure that when they reopened, they were well prepared and they didn't have any second wave. In Korea, bigger wave, but once the wave came down, they had a little bit of a plateau, and now they're at 0, and they've been staying at 0. So the evidence from Asia, and we as a country should be as capable or more capable in rolling out the reopening plan and making sure that the testing meets the criteria. And here are the 4 components that we're monitoring on how each state is managing the reopening. We already talked about they have to have the right amount of equipment, they have to have the right amount of people to do the testing, they have to do the contact tracing, they have to make sure the hospitalization readiness, capacity of beds, ventilators, supplies, etc. And then they have to have this quarantine or isolation containment practice. And we have that by state in our database. Okay, so we have the 3 states here, the number of tests that they're doing per week, the goal per week, and you can see California, the goal is at 175, they're already past that. Oregon, you can see their goal is 15,000 and they're very close to that. And Washington is taking a higher standard than perhaps the size of their state, which is great. I personally like more testing than less testing. They're at 140,000 as a goal, and they're not even halfway there. So we're watching Washington. Now we know that they're in a shelter at home or work from home through at least the month of May. they're going to maybe start doing some openings on some small areas. You could see the small number of cases in terms of hospitalization for really all of those states compared to, but particularly for Oregon and Washington. So I don't need to tell anybody on the call that Boeing opened up a couple of weeks ago. We're delighted that they did that. They have more than the Seattle location. They've opened up in Philadelphia. And quite frankly, I think the news that we've heard, we're not there every day. They're staggering the workflow. They're distancing people, or they're trying to distance people. They're using personal protective equipment and gear. They're doing the testing of the temperature. And obviously people that can still work remotely, they're doing that. Starbucks, as an antidote, 90% of the Starbucks in China are now open, but in the United States, they're opened up just a couple of days ago, and they're doing a whole set of practices and protocols. I'm now going to turn it over to Robert, who will talk about the economic impact and the policy response.
Thanks, Garrett. Let me transition to sharing my screen here. And thanks again for everyone joining us this afternoon. Just a couple quick housekeeping items. One, Chad mentioned the Q&A box at the bottom of your screen. Feel free to type in questions. We'll try to get to those at the end of the presentation. Second disclosure I like to make, what's behind me is my 1-year-old's crib. This is my safe room, 8 weeks into work and school from home here in the San Francisco Bay Area. I have 2 small boys, so if you hear any screaming noises or barking dogs in the background, that's what's going on. Don't take any alarm to that. But I'm going to focus on the economic impact and the policy response along with portfolio positioning. And the economic toll, as you can see on this screen, has been just staggering. I'm going to throw this word out a lot, and for good reason. This is unprecedented, what we're seeing in the near-term economic data. We can't update the job loss numbers fast enough. We're up to 30 million when we look at weekly unemployment claims. To put that in perspective, the biggest one data point reading in unemployment claims before this was around less than 1 million lost jobs. And we've had weeks with 6 or 7 million lost jobs in this crisis. And this has hit small businesses worse than any other area. We've seen more than 50% of small businesses closed. And going into some specific data here, we're focusing on California, Oregon, and Washington again. What you see here is employees working, hours worked, and locations open. This is small business data, and many of these numbers are over 50% declines from pre-crisis readings in terms of employees working, hours worked, locations open. So small businesses have taken this a lot harder than many big companies. And if we go to the next slide here, we'll look at some of the policy response that's been targeted for small businesses. So as Garrett alluded to earlier in the presentation, the policy response from the Fed and Congress has been remarkable in a lot of ways. The CARES Act had a strong focus on small business loans. So the initial $2 trillion had hundreds of billions earmarked for small businesses that was absorbed very quickly. Extreme demand for those loans, and that we got another 500 billion authorized and in the process of deployed. And you can see there's been demand for this across the country. For the US, we've seen almost 4 million approved loans. We've seen the average loan size being over $100,000. And this is huge for keeping a lot of these businesses going, trying to keep employees on the payroll as long as possible. Because the main theme of this crisis is trying to get through the next couple of months. We're going to talk about how bad some of the economic data is, and the policy response is central for getting through this. These are very interesting statistics when it comes to unemployment pay. So again, the theme here, California, Oregon, Washington. What you see here is the state unemployment benefits at the bottom in dark blue, and then in light blue, the additional $600 a week from the CARES Act. So what this is doing is actually putting money in people's pocket that in some cases goes above what the median weekly earnings in the US was. It's hard to believe that there's a number of individuals that are actually going to see an increase in take-home pay temporarily. And that's important. Again, with this crisis right now, we need as many people as possible to continue to be able to pay the bills, to get through the next 2 to 3 months, so when things reopen, that we can jump back a lot faster than had we done nothing. And we're going to talk about what the market has done during the last month. And the policy response has been central to stabilizing the market and keeping money in people's pockets. So transitioning into some of the company-specific data and comparing this crisis to what we saw during the Great Financial Crisis. The good thing about this, Garrett mentioned this as being a one-time event-driven crisis versus a full-fledged financial crisis. What this slide shows is the default risk. We just picked 6 bellwether large cap US companies across multiple sectors and compared their default risk from 2008, 2009 to today. So as bad as this crisis has been, the default risk for your average large cap company in the US is below what we saw in 2008. And I think JP Morgan is a great example here. 2008, 2009 was a financial crisis. We were worried that the banks were going to go under. We were worried that money market funds had potential to default. And you can see now the market is actually more worried about a company like Disney than they are JP Morgan Chase, which is telling. And how this relates to positioning portfolios, we really want to focus on high quality companies that have the balance sheets and earnings to hold up during this crisis. Again, we mentioned small and medium-sized businesses have been the ones most affected. In our portfolios, we focused on avoiding those companies and really holding on to the high-quality stocks and portfolios. For clients that work with us already, they may recognize this page, our economic and financial indicators. These are the 20 most important economic indicators we use to project the economy over a 3 to 6 month basis. Normally, these indicators are central to building out a portfolio. But in a crisis like this, why we start with all the COVID-related data is because that has more of an effect on the key question. How quickly can we get the economy back open? I get a lot of questions from clients. Well, if we know Q2 is going to be one of the worst quarters in history, and it will be, then why is the market going up? Why are we talking optimistically in a lot of areas? When we look at the economic data, I mean, it's unprecedented. Everything associated with the US and international economy that's related to economic growth is in red. We are a consumer-driven economy here in the US that relies on individuals spending money. And when you have 90% of the country at a stay-at-home order, obviously no one's going to be spending money. We have a savings rate that's as high as we've ever seen it. But you can see some of the green indicators on this page, which lines up with what we've talked about. The Fed response has been absolutely unprecedented in its speed and strength. The response from Congress on fiscal policy has also been enormous. Again, $2.5 trillion potentially for more. And the other thing that doesn't necessarily get that much attention is where interest rates are. We're going to be looking at historically low interest rates coming out of this. So if you are in the market for a home, for a car, borrowing costs are going to be about as low as they've been in history, maybe even lower than we saw coming out of the Great Financial Crisis. So when we do get to the recovery period, there's some positives out there. But when we talk about economic growth in the short term, I mean, these numbers are surreal. We're looking at Q2 economic growth minus 27% to minus 43%. To put that in perspective, in 2008, 2009, we saw the worst quarter being around 8%. So this second quarter is likely to be 4 or 5 times worse than the worst quarter in modern US history. But at the same time, when we go into the rest of the year, the bounce back is likely to be sharp. So again, this doesn't mean we're going to flip a switch and have everything go back to normal. It's not going to happen that way. It's going to be a long extended recovery. but the economic growth should start to bounce back in Q3 and Q4. So what I like to focus on is more of these bottom numbers. Instead of throwing out these big numbers, let's look at the full year estimate. And that's about a -6% number for the economy as a whole in 2020. And that's not a good number. But the difference between now and a 2008-2009 scenario is we're projecting a very strong bounce back in 2021. And visually, this slide is nice. You may have heard letters thrown out about the recovery. I've heard V-shaped recovery, U-shaped recovery, K-shaped recovery. But I think this looks more like a Nike swoosh-like recovery, where we have a sharp downturn, which we talked about, a quick bounce back, but an extended run back to where we were pre-crisis. And I think that lines up with how we see the virus right now. There are going to be certain sectors and industries that are able to be more resilient, bounce back quicker. And then there's going to be other sectors that are going to take years to recover. So I'm getting just a ton of questions from clients about Warren Buffett's talk over the weekend. And he did a heck of a job for a guy in his 90s, talk 4 straight hours uninterrupted about all these topics. And we tend to really agree with him on his positioning. He announced that he was selling out of all airline companies, as an example. He announced that Berkshire wanted to hold on to a nice pile of cash, given that there's not necessarily opportunities out there. And it makes a lot of sense. There are industries that are not going to see recoveries for years. We talked about airlines and transportation businesses. I mean, we saw airline traffic drop 97% at one point year over year. Restaurants, hotels, casinos, sports and recreation. As optimistic as some of the virus trends are, it's not likely we see any professional sports in the U.S. with fans anytime soon. I'd be shocked if we're filling up NFL football stadiums in the fall, even if the season is on. And those are industries that are going to take years to maybe get back to where they were. Whereas there actually are some winners in this situation. Retail, food and beverage shops, some of the public services sectors are seeing inflows. So when it comes to investing a portfolio right now, we almost think of it in 2 different ways. Here it talked about our analysts looking at very high quality stocks that have revenue streams that are likely to be okay through this crisis. But at the same time, we're comfortable holding on to a little bit of a conservative positioning, holding on to a little bit of cash in case we do get opportunities to buy. So we really do agree with Mr. Buffett in a lot of those comments he made about positioning. And another thing that comes up a lot is talking about the outlook for bonds, specifically municipal bonds here. And I thought we'd focused on more of the West Coast story, because when you're investing in tax-exempt securities, your state of residence makes a big difference in some of the opportunities that are there. You'd have a different municipal bond portfolio if you're a California resident versus Oregon versus Washington, depending on the taxes. And I think municipal bonds have always been a good investment source for tax-exempt income, but I don't think there's ever been a period like this one with so much uncertainty around municipal bonds. So the nice thing about our firm, I feel very fortunate to have 2 municipal bond teams that I get to work with, one that focuses on the high yield part of the market and one that focuses on the investment grade part of the market. So by having a team that does nothing but focus on this part of the market, we're able to position in areas we see opportunities. State and local governments are going to come under tremendous budgetary stress right now. An example of a type of municipal bond that might be attractive is one tied to essential services, essential revenue bonds. Think of a utility or a water project. These are the type of services that aren't going to shut down no matter how bad it gets. So when it comes to investing a portfolio right now, I'm comfortable admitting we don't know what's going to happen. We think that we are positioned well if there is a second case with the virus, but we want to position portfolios on the stocks bond side that can hold up in a variety of different scenarios as they play out over the next couple of weeks. Risk management is a big thing I hear from people. You know, what do we do? Are we protected if we get this bad scenario? And one of the things we've been looking at is the weight of the top 5 companies in the market. So looking at this chart, the top 5 companies in the market represent close to 20% of the S&P. This is the record for this statistic, even going past the dot-com era. And if we look at some specific companies, here's 2020. The companies are all big tech: Microsoft, Apple, Amazon, Google, Facebook. We'll all agree these are very good companies. But if we go back to 1998, 2002, it was a similar story, just a different list of companies, except for Microsoft. We had Microsoft, General Electric, Intel, Cisco, Walmart. And the theme is these companies are trading at valuations that are much higher than the overall market. In the dot-com era, it was about 100 times earnings for the list of these companies representing 15% of the market. And the returns after the bubble popped were not great. You can see the numbers here. Walmart was really the only one to hold up. So we're not necessarily looking at valuations that were as extreme as 2001, but they're starting to creep up. We're looking at an average of about 40 times earnings across these 5 companies. And the risk in that is I see a lot of investors flooding into passive products that just track the market without realizing how exposed they are to maybe individual companies. So it's one thing we're looking at closely is the concentration in the markets. And we talked about valuation of the stock market. Another comment I hear from time to time is, you know, this is a fantastic buying opportunity for stocks. And when you look at it on a valuation level, you know, valuations are only one part of the story, but stocks look a little rich right now. This number is maybe being inflated a little bit by those tech companies that are trading around 40. But with this rally over the last month, you know, stocks certainly don't look cheap going forward. So with that said, this will be the last slide I cover, and then we'll open it up for some of the Q&A. I mentioned the uncertainty. This looks at bear markets or crisis situations going back to 1966. And one theme across all of these bear markets and crisis situations has been there have been meaningful stock rallies in the middle of the crisis. And history doesn't always repeat itself, but in each one of these crisis periods, we saw stocks having another correction. In 3 cases, stocks making new lows, 1973, 74, 2001, and 2008. We don't necessarily know what's going to happen this time, but again, we're preparing for more volatility. Knowing that the economic data is going to be bad over the next 2-3 months is likely to lead to some more volatility in the stock market. Going into the health data, movement either way could lead to volatility up and down. We have a lot riding on science right now. If we get accelerated timeline on vaccine, that could push the market up. If we get the opposite, negative news on vaccines and drugs, that could certainly lead to more volatility in the stock market. So we really want to position portfolios to be able to withstand kind of both of those situations. And it kind of is our job to balance all of this information. Hopefully all this was helpful, showing you how we analyze the virus-related data, the economic data, and put it all together. So with that said, I'm going to turn it back over to Chad to start the Q&A process.
Well, first off, thank you so much, Robert and Garrett. That is wonderful. And I know you guys put a lot of time into putting this together for us over here on the West Coast with, just so you know, Garrett, one comment, it's Oregon, not Oregon.
Hey, thank you.
So I'll skip over that question, just make sure. So, and just also that we did know that there was just a little bit of a superimposed with the Washington and Oregon. We understand Oregon has no sales tax and Washington has no income tax. So that was just a little human error on our end with those being superposed on as far as the taxes. So I know there was a couple questions on that, and sorry about that. That was just a little human error on our part, putting that together with the difference between the sales and the income tax. So I want to get to a couple of questions here, Garrett. We actually had quite a few, so I'm going to try and get to as many as we can as we're going through this. And the first question I think that we want to get into was basically based on the all the possibility of substantial inflation pressures on the U.S. due to the impact of the trillions of dollars of government printing and putting into circulation. What's going to happen long term with our government and deficit?
Inflation concerns are valid, justified, and on our minds and many other minds. Let me bring a few things into this conversation. So the debt that's being created today, call it $3, $4, $5 trillion, ultimately they have to put that into some category, and just as they did after World War I and after they did after World War II, they have to put that into a program where they start to pay it down. I'm skeptical that they'll do that, so I don't want anyone to feel that we have high confidence there. So if they don't do that, the credit card limit of the government, they're very close to 100%, or actually going to be over 100%. What that means is they have much less spending authority in the next recession or in the next crisis where the government has to do all of this stimulus. So it's not automatically going to cause inflation. That's absolutely not going to happen in the next 1 or 2 years. In fact, low inflation or very low inflation is the biggest concern over the next 1 or 2 years. Longer term, if they don't get the budget deficit on some spending declining, then they have less capacity, and then they won't be able to react as much. So I understand the concern, but they had enough up to this point, money left on their credit card, despite what the press says. The press can say, you know, they're out of their limit. They did have enough. They spent to the limit, but this is pretty much getting them close to the end before they do have a bigger problem later on.
Thank you. And I'm just going to follow up on that from another question that we had prior to this was, how does that affect, there's a lot of talk about the US dollar and that the dollar, because of all the printing, is going to be worthless. How does the concerns of the deficit affect the US dollar?
So the US dollar, if you compare that to the euro or the yuan or any of the currencies around the world, actually has been one of the strongest currencies for many, many years. And the reason for that is the economic system that we have is proving to be resilient, flexible, creative, R&D. It's a very creative, dynamic, resilient economy, and that creates lots of profitability. The stock market's at an all-time high before this crisis. We have tremendous strengths as a country in law and stability and all those other things. So the currency represents a representation of many facets of our economy, not just the deficit. The deficit is not ipso facto bad if you have plenty of revenue to pay it off. So the question becomes, how are the politicians going to bring about a little bit lower spending or a little bit higher taxes? That's the debate, not can we pay this debt amount off? It's how do you do that? And honestly, they have had no courage on either end in doing that. They shouldn't have done the tax cuts to some extent, because that just created a bigger deficit. Maybe they shouldn't have done as much spending as they have. I think actually it was the right thing to do in this short term. So I wouldn't worry about the dollar, and I wouldn't worry inflation for the next year or two. It doesn't mean it's not a problem, but it could be one, but not in the horizon for the next couple of years.
Thank you. I think this might be a little bit going to Robert on this one, which was the question that was emailed to us is, what sectors do you guys have belief in as far as remaining vital over the next 2 to 3 years, are at the greatest risk of unknown weaknesses, and then what probably have the most likelihood of shrinking or collapsing down the road?
Yeah, that's a good question. I think that goes for part of the story I talked about when you broke it down by industry. So a great sector to talk about is the energy sector. You know, traditionally in the past, energy sector has been a great source of dividends and has attracted a lot of capital. You know, certainly energy stocks have been, you know, one of the hardest hit with oil prices staying low. So our outlook for a very slow Recovery out of this for energy stocks means that's one you really want to avoid. Trying to speculate on the sectors that have been hit hard, COVID related, airlines, hotels, casinos, energy stocks, some small financial firms that have been hit. That is not the way we think that you want to play this. You want to focus on the sectors that are likely to bounce back really quickly. Technology, restaurants that not restaurants, but grocery stores and consumer staples that are selling products that are in high demand. Consumer dollars are going to go to those things before they go to the more discretionary sectors.
Okay, thank you. One last email question in here is understanding that with the fixed income, it feels a lot less safe than it did previously. What sectors of the fixed income market are secure, and what sectors will still need to heal?
Yeah, that's another one that I can take. We talked about the municipal sector before, so I'll talk about some of the other areas of the bond market. Treasuries, to start with, have really rallied this year. Everyone has poured money into government bonds. Those are obviously the most secure fixed income markets, but your opportunity to generate returns there are almost nil. So we definitely recommend, and part of our strategy is to look into other parts of the fixed income markets. High quality corporate bonds and municipal bonds are very attractive right now. The Fed support has been monumental for really giving us reassurance in parts of the bond markets there. I think you need to be very selective about the companies on the corporate side and on the muni side, like we talked about, the parts of the market. So good opportunities there. And then for clients with risk tolerance that have the ability, one of the most attractive parts of the fixed income market is one of the hardest hit areas, the high yield sector. So oftentimes in periods of crisis like this, you see outflows of high risk bonds and losses there, where the recovery story sometimes is even quicker than on the stock market side. So we see some good opportunities in some of the higher risk areas of the bond market, but definitely favor going out of treasuries into corporates and munis with money earmarked for bonds.
Thanks. All right, there was quite a few comments coming from us, and I'm just going to kind of summarize quite a few of them into one, but kind of from a national standpoint, obviously we talked a lot about New York and then on the West Coast, in that New York looks like it's coming down as far as the number of cases. There's quite a few states that obviously haven't met that 2 weeks of declining new cases, but are still opening up. So how does this affect your forecast, especially if there is a second wave of increasing cases?
So I'll take that one. When a state reopens, and McKinsey's working with a couple states, Harvard's working with a couple states, University of Washington's working, they have a go slow reopening protocol. So in New York, I'll just use that. They're not going to open up in Midtown Manhattan. They're going to open up in upstate in the more rural areas. And then within the rural areas, they're only going to open up in manufacturing or construction or agricultural jobs where people are 6 feet apart and they are able to maintain social distancing. So if there is a second wave, they would not have that happen in the main centers of Seattle or Manhattan or Dallas or Chicago. It would happen, if it was going to happen, at a smaller level, and the hospital capacity should be proficient for that. I know that there's going to be a second wave in some cities. It'll be a little bit in others, but I really do think the Asian experience shows the way. And Robert, if you can maybe go to that page. It was really stark reality when we looked at this data. From February 22nd or 28th, actually, in China, they've had almost no cases. Now that's a population of over 1 billion people, and their density, their interconnectedness, the mass transit. Many of you have been there. I've been there many times. It's more dense than New York could ever be in many ways. So there's reason to understand that it doesn't have to be this massive second wave that the media is trying to get us to believe in. I don't want to predict, but if they do the testing, tracing, and tracking well, we should have a modest second wave, and then they'll just slow it down. And that's the final thing I want to say. They're going to open up a little part of New York or a little part of Texas or a little part of Chicago. Then they're going to let that settle in for a week or two before they open up another part. So I think they'll manage this quite well.
Thanks. We actually, that was probably about half the questions was kind of coming back to that. I think that's the biggest news now is that Fauci coming out saying there's going to be the second wave and what is its impact. And I think that helps to kind of take a look at the data. Quick question for you. What is the difference between fiscal policy and monetary policy?
Yeah, so I'll take that one. Let me put it in terms of how it impacts a person who owns a small business or a person who's unemployed. So the U.S. government mails me a check, or the state government mails me a check if I'm unemployed. That's fiscal policy. That's financially spending money. The Federal Reserve, think of them as the printing press. They actually print they print the money itself. So the Federal Reserve doesn't actually go out and give you the money. They give it to the government or they give it to banks. So think of the Federal Reserve as creating the physical money. Now, obviously, they don't do it in physical money. They do it in electronic form. And that printing of money goes either in the hands of the U.S. government or in the hands of the banks. If it goes in the hands of the U.S. government, we know what they do with it. They spend it. Okay. What the banks do with it is they hold on to it, and people come in and take a loan, and that's how they create money, or they take some other, PPP plan. So that's the difference between the two.
Thank you. Question here. While we appreciate the help, where did all the money for the loans and stimulus checks come from?
Yeah, everybody that's listening to this call that has a portfolio with Chad, myself, Robert, and others, it came from our paychecks through higher taxes. So look, if you can think of the capacity of the U.S. government as having a credit card limit, and there's a lot of debate on what the limit is. Some people think it's 20 trillion, 25 trillion. I've had the pleasure of spending many days and weeks with Chairman Bernanke, and before him, Chairman Yellen. And so Ben Bernanke ran the Federal Reserve Bank that prints all the money during the great financial crisis in 2008, and Janet Yellen, obviously the more recent one. And they were very clear about the credit card limit of the U.S. government not being exceeded at this point. They think the limit is high, but the way I like to put it, not that I do it this way, but if I have a credit card and I have a $100 limit, if I go to $90, I'm still okay, right? If I go to 99, I'm still okay. If I go to 100, then I'm out of my capacity. I have to start paying it down a little bit. The debate is, what is the limit for the United States? And if you look at other countries, we're high, but not nearly as high as other major countries. So the capacity or the credit card limit of the country, it's up at or close to the limit, just as it was after World War I or World War II. They worked it down over 10, 15, 20-year period. That's the problem that we foresee, which is there's nothing wrong with borrowing. Many of us borrowed to buy a house. We paid the mortgage down over time, and we owed the house. That's a good use of debt. You borrow to build a business. You pay off the debt. You own the business after years. The problem with debt is only if you don't at some point get to start paying it back. And we know that the government has not been fiscally responsible in that regard for the last several years. And I don't think they're going to become fiscally responsible for the next several years. And it's not Democratic or Republican, it's just the state of mind. But at some point, the markets are going to say to the government, you have no more credit available, so start paying us back. And then they'll have to become fiscally responsible.
Yeah, and the last thing I'll add to that, Garrett, is if you're the government and you're picking a time to borrow money, this is probably the best time to do it when interest rates are as low as they are. So think of it from the individual standpoint. We talked about that house buying example. If you're going to buy a house, might as well do it when the 30-year mortgage is at record lows. Government gets to issue these treasuries at record low interest rates. So it becomes very important that when we do get 5, 10 years down the line and interest rates go up, as Garrett mentioned, that's when the decisions have to be made to stop borrowing, because that cost of servicing the debt is just going to grow and grow. But in the near term, it seems like a good policy choice. You want to spend money in the time of crisis. When things get good is when you want to be more fiscally conservative.
And that's the point, Robert, right? So we had a 10-year bull market after the '08 crisis. Fine, you can't pay it back right away, but they should have been chipping away at it in the last couple of years. And that's our point, right? We need to do this now. We want to help the businesses and the people who, for no reason of their own, have lost their jobs. But there needs to be a plan to pay this back. And I don't have confidence that that's going to happen in the next couple of years, unfortunately.
Mm-hmm. That kind of leads into our next question is, are state pension programs at risk as revenues continue to decline?
Yes, depends on the state. And the same thing we've said about the federal government, we could say about the state governments. No one on this call lives beyond their means. The reason you're on this call is because you took a part of your paycheck or your business income, and every month or every week you socked it away and you saved. For some reason, states and federal governments are not practicing what we all have to do as individuals. And that's a societal issue, right? So, we know some of the states that are in serious, they haven't funded their pension plans. They will borrow to get those pensions done. But unfortunately, as we've seen, some of the states have had to renegotiate the pension payments for some of the retirees. And no one is holding the people accountable, those that were in office when they created that problem. That's quite frankly, the unfair part of it. But some states are just not balancing the books, and the pensions are going to have a problem.
A lot of questions, a lot of distrust of China in a lot of our questions. So kind of a good one I thought that kind of came into this is China has been known to be one of our largest debt holders, and obviously we're issuing a lot of new debt. Who's going to be buying all of this debt that's being issued for the money that's being spent?
So the reason why China is doing that isn't because they like or love, they do, quite frankly, admire the United States on many levels. So when they sell us a lot of the goods that they manufacture, we mail them US dollars, right? So they now have hundreds and hundreds of billions of dollars being mailed to them. They have to do something with those US dollars. They can put it in Chinese bonds or US bonds. And quite frankly, most of the people that get that money say, I think the US government is a heck of a lot safer than the Chinese government. So that's one of the principal reasons that they reinvest. The same thing on the government level of China. They're saying, I need to keep the Chinese economy moving ahead. I want to keep the flow of goods and orders coming. So I want to buy the bonds of the United States so they keep their interest rates low, they keep their money flowing, and I can keep creating jobs. So it's a mutually reinforcing behavior pattern that I read occasionally. There's some article, they're going to stop buying our bonds and inflation is going to go through the roof. While anything is possible, the likelihood of that is very, very low right now.
Good. Thank you. We had a question. How do the provisions of for charitable giving under the CARES Act affect how individuals should think about giving to nonprofit organizations?
I should probably have the expert Chad talk about that. So could you is there another part to that question? Should they be giving or not? What was
that was pretty much that one. So that was the full question on that. It's the provisions under the CARES Act. So so I'm not exactly sure if they're thinking if there's a negative. So I wasn't quite sure.
Okay, I think what that well, actually, why don't we do this? Because I know they've adjusted the IRA. You don't have to take the IRA this year. And I don't recall the particular part about the charitable giving. So we'll be happy to come back and we can follow up on that point.
Perfect. Yeah, no, there's no required minimum distributions anymore for those who are now 72 and older. So yeah, there's quite a few. So we'll follow up on that one separately. Going back, I'm just kind of getting back to it. So kind of beginning where a little bit started is Buffett sitting on a lot of cash and not re-entering the market right now. I know we touched on this a little bit. Why are you getting back in the market with this volatility of an unknown future?
Yeah, so I think I touched on that a little bit in the conversation where we have a similar approach. I mean, you look at a company like Berkshire Hathaway, you know, he's got investments in a ton of very high quality companies on top of that cash. And I think of our strategy as very similar. You know, we want to focus on very high quality companies that we know are going to be around for years to come. We know they're going to grow their profitability over time, and we want to stay invested in those companies. Yet, on the other hand, there are a number of companies that we look at that we say, hey, you know, maybe now is not the time to jump into those companies. We'll look for maybe some better opportunities to enter them and are comfortable holding on to a little bit of cash. So, you know, I understand where he's coming from, saying, you know, it doesn't necessarily look like there are a lot of buying opportunities. You know, unfortunately for Buffett, last time around, maybe the Fed acted too slowly. So there were opportunities for him to come in and get really nice deals and support certain businesses. And this time, I mean, he even tipped his hat to Chairman Powell in his conversation, saying, you know, they did a fantastic job acting quickly. You know, it really helped stabilize the market. And, you know, I think Buffett didn't see any opportunities to deploy some of those billions.
And let me complement that point, which in investing, we all have our goals, and Chad, you do a great job of setting the client's goals. And the way we think about businesses and ownership in businesses in 3 years, 5 years, 7 years, and 10 years. And we know right now everything's down, and we know the uncertainty is extremely high, and we know there's lots of negativity. What we don't want to focus on is not the next 1 week or 3 weeks, because there's something called market timing. And the reality is no one on the planet Earth can do this market timing consistently enough for the long-term investor to end up at their goals. So we do agree that if I was a genius and I said, get in this week, get out next week, get in, the problem is that's not doable. So you want to have the right amount allocated to equities in the companies that Robert's articulated, and you're maximizing the achievement of your goals if you stay tactically around that right amount of equity rather than getting in and getting out, despite how appealing it might sound at the moment to get out of stocks.
The importance of investing and not day trading. Yep. Yeah, good. Well, I want to thank both Garrett and Robert for the time today. We're right at the hour mark, and I want to respect your guys' time. If you did have questions on there, we're going to try and follow up with each of you that asked questions separately and individually, just to make sure that we answered them. And again, just really appreciate your time, really appreciate the slides, and please keep doing great work on all that research for you guys.
Great. Thank you all very much.
Thank you.
Thanks.